Good afternoon, everyone. Good morning in some places of the world as well. Hello, my name is Michael Mandarino. I'm a financial advisor. My company's 123 Investing, and we're almost ready for the year end. My firm, we've been in existence since 2006. I've been a financial advisor since 2002. So for those that don't know me, I'm a graduate of the United States Military Academy. I served 5 years on active duty, mostly overseas, and I'm really looking forward to being able to teach a little bit about some of the tax strategies, especially for the year end. So without further ado, I'm going to go ahead and take a look at some of the disclosure statements here on the next slide. So as you can see here with our disclosure slides, this is not an offer to sell or buy securities. However, this is an opportunity for you to learn a little about some of the tax strategies. Some of the tax strategies that we actually do at our firm. Most of these strategies can still be implemented this year. Some of them, we'll have to wait till tax year 2025. There are some forward-looking statements and comments are on here. Again, these are some hypothetical events. Um, I do not ask and I do not provide tax or legal advice. That you should consult with any type of a tax accountant. And this presentation is based off of the tax rules right now. Today's date is December 20th, 2024. So things absolutely can change. You can visit my website, www.123-investing.com, to be able to receive our Form CRS or Form ADV. And that's also found on garepl.com as well. So without further, one of my favorite scriptures in the Bible is where there is no guidance, the people fall, but in abundance of counselors, there is victory. And for those that personally know me, this is actually also on my business card as well. So I truly believe, having a tax accountant, having a financial advisor, having a CFO for your company, those are all certain things that most individuals should have, especially looking long term. And again, just offering new ideas and new perspectives as well. And I do work with other financial advisors as well. Some of the investments that we offer at our firm are very unique. So I do work with some of the other financial advisors as well to help their clients on some of the specific things that their firms may or may not offer. So the first thing we're going to talk about today is the tax benefits of oil and gas partnerships. So in oil and gas partnerships, typically these partnerships do provide a significant upfront deduction that can potentially help lower your taxable aspects, and also you can also lower the taxable aspects of some of your clients as well. It does potentially provide a not guaranteed, but a non-correlated long-term tax advantage for streams as well. So, there's just some ideas that you can kind of take a look at it and see. And when it comes to, give me one moment here. I'm gonna post in a few things for those that are on the chat. So you can, for those that may want to join us live, they can also join us live on some of these as well. So you should be able to see the links in the chat there as well. So moving forward, the biggest tax advantage when it comes to most oil and gas partnerships, it becomes the intangible drilling costs. And I'll go over that on the next slide. But these are really the top four reasons of why there are some potential tax advantages. Mostly, also good to know is this is a very high and speculative investment as well. So some of these investments, you can lose up to all or all of your money or some of your money as well. Tax codes can change as well, but let's go and see right now based off the current tax code. So what is an intangible drilling cost? Well, when you purchase and get invested with a limited partnership that has, or a general partnership that has oil and gas as one of their main areas, the IRS does allow for an intangible drilling cost. So that is the cost to what it costs to put the wells and make them operational. It's a labor cost, the Department of Labor cost, the cost for insurance, all these costs go in there. So the IRS does allow for an upfront, and in most cases, it's anywhere between a 60 and 80% deduction of your first year above the line investment. And then we'll show that here, what that looks like here in a little bit. Again, that's really one of the main reasons that people love these. In addition to having an asset class that's invested in the natural gas and real estate, natural gas and oil space. What are some other potential tax advantages? A lot of these partnerships do come with an accelerated depreciation that happens in the second year, and that can be as high as anywhere between 10 and 12% of your investment. So if you look at that 60 to 80% that could be there for the intangible drilling cost, there can be anywhere between 70 and as high as 85, 90% of your initial investment, you could get some type of tax break. Again, that is not guaranteed. It is based off of today's tax code environment. And again, that's all subject to change. And those are things you'd obviously want to consult with the tax accountant on the specifics of that. Percentage depletion allowance, this is part of the tax code. So 85% of the distributions off of most of these partnerships are taxable. 50% of your distributions do become tax-free for the lifetime of the partnership. Again, that's based off of today's tax code. And then ultimately, I won't spend a lot of time on this, but there is tax savings. Obviously, you're going to potentially get some money back from the IRS, or you're not going to have to pay the IRS depending on how your taxes are structured. So you can possibly use that in another type of investment. Again, I'm not going to harp on that one, but those capital, it's not sent to the IRS. That's money that's back in your pocket that you can do as you choose. Our next subject I'm going to talk about is business real estate planning. So in this slide, we're going to kind of show some ideas. What are some other thoughts that you may or may not have thought about when you're getting ready to, sell real estate if you're a real estate investor. So in this slide, I'm going to kind of orient you on the first one we're going to look at is, when you sell a property. So in this case, across the board in all examples, we have a $2 million piece of property. We purchased that property for $100,000. Again, this is a hypothetical. So your first option is just sell the real estate outright. As you can see, pay now. There is a recapture tax of 25% plus capital gains 20%. So we're estimating, again, this is not guaranteed. It's just for this illustration purposes. But the option would be is you're going to be paying about $412,000 in estimated taxes. Again, that's going to be the result of the investment of just selling it outright. And then you have a second way. You can pay those same taxes over time. So using that same example, instead of having all the capital gains right now, you might be getting an installment sale where you're getting some of that payments every single year. And of course, as you're getting those payments in, that's where those taxes are going to be. So, you're going to be paying your taxes over time. So you can do it over a multiple year period, however that's structured. The assets included in the estate. There's no creditor protection, and there is a recapture of the accelerated depreciation that was potentially done. So also, one of the other ideas is deferring your taxes. For our real estate professionals that are on the call, that you probably know what a 1031 exchange is, but for those that don't, a 1031 exchange is based off the IRS code 1031, and it allows you to defer taxes. And there's certain things that have to happen, and we're going to talk a little bit more in detail on the next slides. But in generalization, is that same sale happens, but now you're able to defer cost basis into other properties. So if you exchange a 1031 exchange, and there's definitely rules that go with that. But if you sell a piece of property and get into a like kind property within a certain time frame, about 180 days, then you are able to defer those capital gains and the cost basis on a further basis. Again, no creditors protected. You're still going to be the landlord. You still maintain the real estate, so you're still in a real estate type of position. You've not avoided a tax problem. You've just deferred it. And the assets are included inside your estate. Another thing we're going to talk about later is amongst other things, can you avoid taxes? And the answer is, in most cases, you can. And that would be by creating a tax-exempt trust. And again, we're going to talk more specifics about that, but that is a way to sell all your real estate to avoid the capital gain tax. So you avoid capital gains, you receive a lifetime income stream, and you leave a lasting legacy. And then also you avoid the estate tax. Again, those are things that it's very specific. My goal is just to really kind of do a teaching, let you know there are ideas out there. If you're already working with a financial advisor and a tax accountant, ask them about these strategies. If you're not, I'd love to be able to have a conversation with you. My phone number is 813-710-4123. So for those that are just joining the call, my name is Michael Mandarino. I am a financial advisor. I do offer investments through GA Rep1 Company, which is my broker dealer. Our next topic is the Deletour Statutory Trust 1031, or better known as a DST 1031. So I talked about a 1031 exchange earlier. Well, a DST 1031 exchange, it's a vehicle that allows a DST structure to help investors buy a fractional share of real estate. So giving an example, there may be a $10 million piece of real estate that they're going to bring in multiple investors for. And this is really for those investors that are tired of managing property, but they also don't want to pay the big cost basis and capital, or they have a very low cost basis and they don't want to pay the capital gains. So a DST 1031 structure, the way it typically works, it is a replacement property that combines the tax deferral of the exchange with the security and flexibility of the DST. As you can see there, it does, provide potential income stream that's going to come from that. But the really big thing that a lot of our investors that get involved with this is there's no property management obligations. So you're really releasing control of your real estate. You're investing in different types of like-kind properties that could be commercial, it could be joint use, it could be residential, it could be apartments. There is limited liability, personal liability, and there is the potential to own, a portfolio of institutional quality real estate. Again, these are all factors. Typically with a DST 1031 exchange, they're offered all over the United States. I'd love to be able to show you this as an example. If you're in the process of getting ready to sell a rental property and you don't want to pay the capital gains, but you also are looking at, maybe I do want to surrender and no longer be a landlord. And also talking to some other folks in the commercial real estate space, for those who are buying and selling properties all the time, there may be still money that when they sold a property, let's say for 5 million, well, they might buy their next property for 10 million or for 4 million, excuse me. So there's still $1 million that was left outside. This could be a great alternative as a position that you can still put some of this money and diversify it into this DST 1031. You can also choose multiple DST 1031 exchanges if it fits into your investment strategy. So let's take a look at the timeline. So again, we have an investor who is getting ready to relinquish the property. We have the purchaser of that relinquished property. They send the cash to a qualified intermediary after the sale and the closing. That cash is then going to be used to potentially acquire a piece of property. And that property, for instance, for the investor is, when you look at the overall timeline, I'm just going to bring everything up here. You have day one is when the relinquish the property happens. Before the end of 45 days, and this is key, you have to identify up to 3 properties, regardless of value, or a combined value not to exceed 200% of the value of a relinquished property. So that's something that you need to do. If you are a real estate investor and you love doing these 1031 exchanges on your own, we always like to just say, let us be your second or third option, just in case, as I'm sure folks who are in real estate, the closings don't always happen when they're supposed to. And again, for this to truly happen, you actually have to acquire that property within 180 days. There is a time limit the IRS gives you. And again, from start to finish, that's 180 days that you have to be able to require that. So, why do a DST 1031? The biggest reason that we find is you really want to be retired from being that landlord. Maybe, you're sitting on a residential or a large apartment complex. You've had it for 20, 30, 40 years, and your kids have no intention, or your beneficiaries have no intention of wanting to be managing those properties. So this is a way that you can diversify your existing portfolio. You can start a new depreciation schedule as well. There's the potential of income. Now, obviously, if you're doing your own real estate, you have most likely a potential of a higher income outlet, but you also have a lot more potential of a lot more risk. So we can look at reallocating your investments into other states, so you can really pick and choose. If you're in Florida and you want to invest in Texas, or if you're in California and want to invest in a property in Florida, because of the favorable taxes, state taxes, those are some things you absolutely can look at. And also, again, just having that backup plan for your existing 1031 exchange. So this is something we'd love to be able to show you some options here. This is really for accredited investors. Most of these investments that I've seen, at least it's on the DST 1031 exchange side, is typically $100,000 is going to be your minimum. They are illiquid investments. Typically, these DST 1031 exchanges do last for about anywhere between 5 and 7 years. They are illiquid, and there's a lot of things that could happen in real estate world as well. But let's see the other reason why people do this, and it's for the tax deferral. So kind of taking a look at that, this is we have a $1 million sale. So we have the original cost of the property, $250,000. Accumulated depreciation was $150,000. The adjusted cost basis was $100,000. So we have a total gain of $900,000. Again, this is hypothetical purposes. This is as of today's date, December 20, 2024. So things can change in the tax code. But in this case, there is a depreciation recapture tax. There is the capital gain at 15%, could be higher for you. What we don't know is to be determined is the Medicare surplus, individual state taxes. So we're not including that. But, give or take, your tax liability is going to be about $150,000. So that net proceeds is going to leave you with about $850,000. Again, that's the sale of the property. That's doing a non-1031 exchange sale. What does it look like in a 1031 exchange? So I'm not going to go through the same numbers, but bottom line is we have a $900,000 capital gain. But look here, we have zero depreciation recapture. We have zero on the capital gains. We have zero individual state taxes, total liability. Now we still have $1 million to put to work in some type of other investment. Again, you're not avoiding taxes, you're just deferring it for the lifetime. So for folks I know that do 1031 exchanges on their own, they typically go from one to the next to the next to the next. Again, you're keeping your investment inside that portfolio and you're just deferring the capital gains. Here's a disclosure slide on that. Please take a look at that. So there's, typically, again, like I said, they're only really available for accredited investors. For an accredited investor, you have to have at least $1 million of assets, excluding your primary home, or for the last 2 calendar years, and including this year, if you're a single investor, you've earned at least $200,000 a year, and then you're assumed to make that, in this case, 2024. So for your 2022 and 23, your adjusted gross income had to be above 200,000. If you're married and you're filing jointly, it would be $300,000 that would be required to you to be an accredited investor. Also, accredited investors are someone who actually has a security license as well. So there's a lot of material risks, illiquidity, tenant vacancies, the general market conditions of competition, lack of operating history. So there's a lot of inherent risks. Please, when you're getting in these types of investments, make sure you're really doing your due diligence to make sure that what that property is doing. Are there tax liens still on the property? Are there taxes owed from the previous occupant? There's a lot of things that can really affect it. And again, this material is not to be interpreted as tax or legal advice, and it is as of tax year 2024. And we do not offer tax advice. Please speak to your own tax and legal advisors for that. So next opportunity I want to kind of talk about is a qualified opportunity zone investment. So this was created in the Tax Act of 2017, and it was a tax incentive for those who have large capital gains from either a sale of a stock, business, real estate, and it allows for injecting money into lower income communities and getting a substantial potential tax incentive to the investor. So there are reasons for that. So taking a look at the initial tax benefits. So again, these are for capital gains. You defer your federal capital gains until 2026. Again, you're not avoiding them, you're deferring them. And that would be paid in the first quarter of 2027. There's no federal taxes on profits if it's held for 10 years. So every state, according to this law, was every state governor and office is able to designate their own opportunity zones in their state. And if it's built and that property is built inside inside that quality opportunity zone, that is where these tax breaks start happening if it's in a qualified opportunity zone. And again, if it's held for at least 10 years, there's no federal taxes on all the profits. So one of the big advantages for those who really want to get into this, and there's the possibility of active passive losses, depreciation equipment on this. So again, this is for educational purpose only. There's a lot of risks involved there. Again, my goal is just to kind of educate that there are things out there. So if you sold property, if you had a large capital gain, if you're looking at deferring capital gains, you have 180 days to make a decision of getting into a qualified opportunity zone. I'd love to be able to help you out if that's you. I know we're getting towards the end of the 2024 tax year, but if you sold a property, a month ago, you still have 5 months to be able to get into that. So yeah, I'd love to be able to comp. My information is in the chat. Please schedule a time. I know if you're trying to do, if you had capital gains this year, earlier in the year, and it's too late to do a qualified opportunity zone, there are other strategies. Again, we're 11 days until the end of this tax season, but there are opportunities. I love for able to help those last people still kind of scrambling of what to do with their capital gains. So we talked about earlier, there was an option of how do you avoid capital gains of a sale of a property. So in this example, we're going to have Mr. and Mrs. Real Estate. We're going to do a $1 million example. They bought a duplex for $350,000. The capital gains were estimated at $650,000. They wanted to sell it. However, they're worried about taxes. But they're also worried about the stress of continuously managing that property. Especially as they want to start maybe traveling more, maybe they're done working. So let's look at an example. So we always ask our investors, if there's a way that you can sell your real estate and pay no capital gains and avoid all income taxes and estate taxes, you can transfer the full value of the real estate to your heirs. And this is interesting, totally disinherit the IRS on the sale of the real estate. And believe it or not, the IRS loves this. They actually give you a tax deduction from the IRS for doing this type of trust. Well, the question is, would you be interested? So let's take a look at it. Again, these are hypothetical purposes. Please consult a tax accountant, as I'm not a tax accountant. I don't offer legal advice. This is strictly for educational purposes. So we have that $1 million. We talked about the $650,000 of capital gains. So in essence, we're looking at, if it was sold, that is leaving about $795,000 left over if it was sold, because that's the taxes. Again, these are all estimations. But if you invested that $795,000 at the end, you're going to provide it a 5%. Again, not guaranteed, but for educational purposes, about $39,750 in income. Well, we talked about let's pay zero taxes. We can completely avoid the recapture. We're going to provide not $39,000 but $50,000 of income, and we're going to bring $1 million to the heirs, and we're also potentially going to give money to the nonprofit of your choice. So when we take a look at this one, this is the idea of, let's see really what happens. So we take that $1 million home, we put it into a tax-exempt trust, and when that goes into the trust, the sale of the property happens. So the house is sold inside the trust. This is before you have purchasers. And the IRS does give you a $300,000 tax deduction. Doing generic numbers, that can provide anywhere between $75,000 and $100,000. So what we do is, if we took that and we potentially bought a second to die life insurance policy, assuming for that married couple, they were married, that could get a second to die tax-free life insurance death benefit, what we call the wealth creation trust. So in this scenario, we started the tax-exempt trust, we sold the property, we avoided all taxes, all recapture taxes. We also were able to buy an insurance policy. Again, health reasons, there's a lot of things that could prevent this. These are just for educational purposes. Kind of get the big picture concept. It might not be exactly $1 million. It could be more. It could be less. But in this scenario, it was $1 million, and that does come tax-free to the heirs. So there's a $1 million tax-free, but that's not it. You also get, while you're alive, or that tax-exempt trust is giving to either yourself or your heirs $50,000 a year. That's 5% of that $1 million trust that was sold. Again, we use the example of the household exactly for $1 million. At the end of the trust period, could be 10 years, could be 20 years, but at the end of that, whatever is left over, again, no taxes, goes to the nonprofit and foundation. That's why the IRS does give this option of giving that $300,000 tax deduct, because there is a chance that you're going to be giving money to a nonprofit of your choice, at least a 501c3. So let's take a look at it. Obviously, the current plan is the taxes of 39 or bringing income of $39,000. Total taxes due were $205,000. The charitable plan, $50,000 of income, so we're getting more income. We have zero tax being paid. In this case, if you passed away, there's assuming you weren't touching the principal, is $795,000 that's left to the heirs. In this case, the heirs get $1 million. And then in our example, the foundation is also getting $1 million. Again, that would be if that $1 million is put into an account. It's not guaranteed, but if we're not spending the principal, that in theory is what can happen. So instead of the first option, current plan is $795. We're able to create a larger income stream and also take that $1 million and turn it into potentially $2 million. Again, there's a lot of risks involved. There are things to explain. This is just for educational purposes, but it is using life insurance as an option as well. And that tax-exempt trust we're looking at for those accountants that are on there, that is a 5227 trust. It is called a charitable remaining trust, charitable remaining uni trust, a new trust, or net income with a makeup trust as well, depending on your situation. Real estate is illiquid. It's placed into the flip trust, which is the MIM trust, then converts to a standard CRUT when a real estate is sold. That 5% income is the minimum required by law. The rates could be higher. The cost associated with these types of trusts, typically 2%. So there are some fees involved with that as well. There are some potential asset management cannot guarantee the yield of 5%. So there's a lot of different things. Again, this is a concept. This is something that if you're looking at, if relinquishing a property and you want to look at avoiding taxes, your goal is to give the money to the next generation, but you still need money to live off of. This could be a great solution. So again, for those that are on a call, I'd love to be able to talk with you. Give me a call at 813-710-4123, or take a look at the chat. My information is in the chat as well. So again, I appreciate those that are on the call. So our next example, so we have Mr. and Mrs. Giver. They received a very large bonus exercise. They're exercising company stock options. Would they consider, Roth conversion? They're going to various ministries and churches and synagogues. So this is a standard giver that we kind of work with, that it is giving money away on a yearly basis. In this example, they have assets of over $500,000, which is can be invested long term. So this is an affluent individual that does have money they are giving. So we're going to see an example. What are some other options out there? They want to continue giving, yet they'd like to reduce their taxes now from those exercise stock options, and they also got that sizable bonus. So the question is, what can we do to reduce their taxes this year? So, and again, love to start back with that question. Is there a way that we could accelerate your charitable tax deduction for your future giving to this year? Would you be interested? And that is what we call and trademarked at GA Repple Company is the Commitment Giving Trust, or the Grantors Leads Annuity Trust. So in this example, we have someone who invests $100,000 into an investment account for a commitment giving trust for 5 years. So we're committing to give $5,000 a year for 5 years. That money does go to a 501c3 of their choice. Typically, the payments go out quarterly. It's held for 5 years, so that's an irrevocable 5-year trust. So very illiquid for 5 years. But what's kind of neat about it is at the end of 5 years, whatever the current value of that trust is, it does get returned to the grantor. So in this particular case, for the $100,000, again, these are based off of, these are some old numbers. So this is based off of July 25, 2023. These numbers absolutely are going to change, so let us kind of do there's some calculators that's based off the AFR rates that does change monthly from the IRS. But in this example, for someone who did this in July 2023, they gave away $25,000 to charity over 5 years. They were able to take a large tax deduction of $22,000 the first year. Now, they're not getting any tax breaks for the following year. But in this particular investor, let's say they were not able to even get over their standard deductions of $29,000, what it is in this year. This gives them $22,000 plus any other giving they had, plus any other deductions. So they actually can probably itemize this year based off of this tax deduction. So that was one of the other reasons to potentially do this, your mortgage interest and anything else that's potentially taxable. Again, I don't offer tax or legal advice, just kind of sharing kind of how this concept works. So, that is about a tax savings, about $8,300 that they're able to save this year, assuming they're able to do that charitable deduction and they are itemizing their deductions. Again, we do some future cost analysis here. I won't go too much into that, but obviously the money that's saved that could be used, the money that this trust is giving, that $5,000 a year, you now freed up potential capital of $5,000 from your checking account to be able to do anything you want. Now you can give extra or you can invest that as well. It's really your choice, but in this case, we are giving off of the bucket of money, in this case, the $100,000. So, there's a lot of ways of constructing this. You can put in more than 100,000, but I just want to kind of show you what it looks like for someone who's, maybe in their 40s or 50s, and they want to give it away for 20 years. So they want to be able to see that $100,000 to those charities over a 20-year period. Again, at the end of 20 years, very illiquid. This is a lot of things that come. There could be some recapture if the grantors did pass away during that 20-year period to the beneficiaries of the trust. But again, this is the aspect at the end of 20 years. There is potentially a return of capital that was invested there versus, writing a check for $100,000. You can obviously do that. You're going to get the tax break this year. We're just showing you take $100,000, giving 5% for 20 years to a charity of $100,000. In the again, going back to July 2023, where the AFR rates was 4.26, that was a first-year deduction of about $67,000. I've looked recently; it's closer to about $60,000 for 2024. But again, that's a pretty large tax savings, about $25,000. Again, this is someone who might just get a one-off bonus. They might have got a stock option this year, and they're trying to, look for ways to reduce their tax burden when it does come time to pay your taxes next year. So before implementing any type of giving trust, it is advised that your tax advisor and legal advisor is definitely consulted. The commitment-driven trust is, again, it's a grantor's leads annuity trust in which dividends, interest, and capital gains of trust will be reported to the grantor annually as taxable income. So that is a pass-through to the grantors. Charitable deductions are limited to 30% of the adjusted gross income, again, based off of tax year 2024. There's a lot that goes in that. Our firm, J. Repple & Company, actually will prepare the 5227 and then the 1041 tax return for the trust. And that's part of the cost associated. Typically, our cost this year is $500 to do the trust documents. So those are all within the fees of what the client would expect to see that. So there may be depletion in the account if the rate of return is not greater than the distribution rate. So there are, again, these are risks, these are illiquid, that we're just showing you different ways of giving. And we're just hoping that this is something that, you may want to implement. There is still time in 2024 to do this. So if you're on this call or if you see this video, please reach out and reach out to us. So, again, for those who have been with us the whole time, thank you so much. My name is Michael Mandarin. I've been a financial advisor actually for 22 years, be 23 years in January 2025. Let's look at partnering together. I work with other financial advisors. I work with clients who have financial advisors, but they're looking for us to do some of our unique tax planning strategies that we do. So really just thank you for everything. I really want to wish everyone a Merry Christmas. God's blessings, everyone on this call. Please reach out. Let's see how we can partner together. My phone number is 813-710-4123. You can reach us on our website as well, which is www.123-investing.com. And also for those who are looking at us other social media sites, check out our YouTube channel. It's at 123investing. Again, thank you so much. God bless you all. Have a blessed rest of your day. Thank you so much.